My name is Jared Salai. I'm a chief strategist at Tricio Investment Advisors. And for the week of the 10th of August, 2026, we shine our spotlight on the US yield and coupon curve. Coupon curve is in front of you here on the chart, along with the 10-year note yield. Coupon curve is basically this yield spread between the US 10-year note yield and the US 2-year note yield. So that gives you kind of an indication of what the bond market is looking at in terms of inflation risk, growth, and everything else. Now, in our spotlight, we argue that we've seen the steepening move, right? You can see the red line went up over the last few years. This partially reflects the fact that the Fed was lowering rates and the long end didn't collapse in terms of long end yields. So we saw the 10-year yield go down from 5% down to 3.6 or so, then bounce back out to around 4.5, 4.6, where it is now. But we saw the 2-year note yield go down a lot and then start climbing again. Now, here's the problem. Now that the 2-year note yield is starting to push higher again, ever since the war in Iran started by the US, we've seen the curve give up some of the steepening. In other words, it was around 80 basis points back in January, the red line. And now it's coming back to around 40 or so. Is the Fed going to hike rates this year? We still think probably not. Non-farm payrolls and U.S. unemployment data for July that came out last week was a bit of a mixed bag. We think it's basically on the soft side. There's some seasonal factors that may need to be worked out, but it's not rip-roaring growth. The coupon curve is showing us right now that the market is saying steepening may be over. Now, we were looking for a move to 120 or so. That's going to be on pause now. We hit our major targets around 80 basis points. And now we're watching and waiting. There's a decent chance that we actually see the curve flatten over the coming months. And we've got to watch this because markets basically fear a flat curve, an inverted curve, a lot more than they fear a steep curve. So it's very early days. Keep an eye on this. If the Fed does start raising rates in 2027 and bond yields, let's say, don't go higher, but in fact, the 2-year note yield rises significantly, let's say to 4.55%, 10-year, let's say, stays at 4.5, 4.6, then you could see the coupon curve start to invert. Again, it's way too early to start to trade this in our view, but it's one of those things that we keep in the back of our mind, and this will definitely be on our radar screen. For further information on Tricio Research Insights and our Ask a Buddy service, where we help clients manage risk and build resilient portfolios, please contact us at info@tricio-advisors.com. There's advisors with an O.